Many of you are asking me for an update on SoFi. SoFi is down 40% year to date. I'm seeing a lot of capitulation from a lot of retail investors on X because the stock just can't go up. No matter what kind of numbers they put up, the stock keeps on going down. Now, the only one that's not capitulating is the CEO. The CEO has been buying up a lot of shares, over 1.5 million shares over the last few weeks. The last time he was buying heavily was mainly in 2024, I believe, when the stock was trading at $8 or $7 per share, and now stock is trading at about $16 or $17, and now he's buying back heavily again because he believes the stock is extremely undervalued. SoFi did really well on their earnings report. They reported a record 15 million members. Their total addressable market in the United States is 250 million of the adult population, and they only have 15 million users. So their TAM and their runways is very large, and they have a long way to go in terms of acquiring members and cross-selling them a lot of products. Now, in terms of the revenue growth, it re-accelerated again to 40% revenue growth from 35%, 26, 38, now sitting at 40%. Normally, over time, businesses decelerate in revenue growth because the business becomes bigger and it becomes much harder to grow revenues. But in the case of SoFi, this company is re-accelerating in revenues every single year. They haven't even got into the decline stage or their peak stage yet the stock is going down. Margin is also expanding, record 30% EBITDA margin. Net income margin is also sustaining at about 13%. I think the CEO said he could take it to 30% over time, but they are right now investing in a lot of research and development. And this is why the CEO is choosing to invest in the business, because he's focused on the long term and he's not really focused on maximizing short-term margins. The company also raised guidance from 30% revenue growth to 32 to 35%. Now, you're asking all these things and you're saying, it looks pretty amazing, but why is the stock going down? Well, it's going down to a few reasons. One of them is the whole assumption around SoFi and the whole expectations around SoFi. So anytime I was analyzing SoFi in the past and I was telling people it was overvalued at 32 and I was trimming the stock, people were telling me the CEO always sandbags guidance. He always set low expectations so he can beat them. And this is 100% true, but this is not what's happening this year. Now, SoFi had 8 out of 8 quarterly beats. They pretty much never missed on their earnings per share guidance. They always guide low so they can beat, and they can raise guidance throughout the year. This is why SoFi's seasonality chart looks like this, with the first 4 months of the year being red, because the CEO comes out in Q1 and he lowballs guidance. Then Q2 comes out and he raises revenue guidance and earnings per share guidance. Then he raises them again in Q3, and it starts as a red year. And after May, June, July, August, the stock recovers and it does really well. Now, this time around, he raised revenue guidance from 30% growth to 35%, but he hasn't raised earnings per share guidance, and he hasn't raised guidance as much as investors were expecting. Now, the reason for that has nothing to do with SoFi's business model or SoFi's business in general, but it all has to do with the uncertainty around the Fed potentially raising rates. SoFi entered the year expecting 2 rate cuts. Now they are factoring in their guidance 2 rate hikes. So the company went from expecting 2 rate cuts to expecting 2 rate hikes, and they're still raising revenue growth. So imagine how much SoFi would have raised guidance if we were getting the 2 rate cuts, or if they were expecting no rate hikes at all. Now, I have a contrarian view, and I don't believe the Fed will be hiking rates this year at all. I've been saying it for pretty much 2 months, and people say, no, they're going to be hiking rates. I don't believe Trump put in Walsh as Fed chair to be hiking rates before the midterm. But you also look at the 10-year, and Kevin Walsh kind of said it himself, that the bond market is doing the tightening for the Fed. So the Fed doesn't really have to hike interest rates because the 10-year and the 30-year, they're spiking up a lot, and they're doing the tightening for the Fed. And that's actually really good for a company like SoFi that can borrow money at low rates and invest in certain ways and collect the spread. So I believe, again, has nothing to do with the business. and we might not get any rate hikes this year. Now, if that happens, imagine how much SoFi is going to raise guidance. So SoFi has a lot of the worst priced in my opinion, unless we get 3 or 4 rate hikes. I hope I'd live to see that. I highly doubt we're gonna get it. To me, it looks really good over here. Pretty amazing setup. Now we look at the company's PE ratio. It's trading at 22 times forward earnings. The stock used to trade at 70 times earnings. Now it's trading at 22 times earnings, with the company guiding earnings per share growth of 42% CAGR from 2025 to 2028, reaching up to $1.12 per share. So you're pretty much buying it at a half peg ratio, 0.5 peg ratio. You're paying 22 times forward earnings, and you're getting about 42% earnings per share growth. The company is literally growing revenues, guys, about 30%, and their net income margin is 13%. The CEO said over the long term, he could expand it to 30%, which means earnings per share will be growing much faster than revenues for many, many years to come. And I think the valuation here is very, very interesting. Now, before I get into my valuation model, I want to talk a little bit about the company's tangible book value per share, because it's still a bank at the end of the day. They have some other services, but it's still somewhat of a bank. The company's tangible book value per share, meaning if you take all the assets, you take out the liabilities, what is, you could say, the breakup value on their fair value assessments, the liquidation value, it's about $6.70. Okay, the company is growing their tangible book value per share about 64% year over year. This is absolutely crazy for SoFi, and for the kind of returns on tangible equity that they're earning for SoFi, the stock should trade at least at a 2 times tangible book value per share. Now, if it trades at 2 times tangible book and they grow tangible book again, the tangible book should be trading at about $10 per share next year. And if they trade at 2 times tangible book, this is about a $20 per share. So I think we're approaching some kind of a floor on the company in terms of its tangible book value per share, where it's going to get too cheap to ignore, that maybe a bigger bank could potentially be interested in acquiring it, or something will have to happen. Some activist will step in. But I think the company will start to get too cheap to ignore. And by the way, I'm using fiscal.ai to come up all those charts. If you want to try it out, they give you 15% off if you want to use my link in the description. But more for my valuation model, I pretty much use the company's guidance of about $1.10, $1.12 by 2028. And this is what I put in here for 2028. After that, I put in 25% earnings per share growth, 20%, 20%. I think it's fair. The current trailing PE is 27 times. I put in 20 times, although I think 20 times is low for a company that could continue to grow for many, many years to come with such a massive TAM. But I put in 20 times earnings. All in all, I'm getting about $40 per share, 141% upside from today's price, or about 19% annual return over the next 5 years. That's using 20 times earnings, assuming SoFi trades at 25 times earnings, which is very possible. I would get almost $50 per share, or about a 25% annual return on SoFi over the next 5 years. So I think SoFi over here is undervalued. It hasn't been doing well. I know shareholders are upset, but the CEO is a long-term thinker. He's a long-term investor in the company. He keeps on buying the dip. I would not be surprised if he buys the dip very soon. And I think the company is approaching a level, and a lot of companies approach this level where they start to get too cheap to ignore, that you have some buyers that are interested. For example, I own a stock called GFL. They're pretty much managed garbage, a garbage pickup company. The stock got to 17 times cash flow, growing free cash flow 25%. And then you have a lot of private equity like Apollo and BlackRock. They start getting interested because the company has resilient cash flows, and the multiple was too cheap, so the stock bottomed at 34, now trading at 42, just on those acquisition rumors where they're not going to be buying it under $50 per share. So some stocks get to those levels where it's a no-brainer. And if SoFi grows tangible book to $10 per share, and it trades at 2 times tangible book, that's $20. If it's under $20 by next year, I would speculate that some big bank will be interested in acquiring it, especially right now with a friendly administration, which is friendly to mergers and acquisitions. I think it's now or never. So that's my opinion on SoFi. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.